Welcome to Remarkable Retail Podcast, our first episode of the year that will be 2026. I'm Michael LeBlanc.
And I'm Steve Dennis.
On this episode, we're starting the year with another edition of The Analysts, featuring Sucharita Kodali from Forrester and Simeon Siegel, now the Senior Managing Director, Senior Analyst, Retail and Commerce at Guggenheim Partners here in New York. Our third regular analyst, Neil Saunders, starting the year off traveling to and from parts unknown, so is unable to join us this time, but we'll get him. One day, we'll get all three of the analysts back on the pod.
We will.
There's some wrangling to be done. It's a good thing you're in Texas. There's some wrangling to be done.
Let's do some wrangling.
Anyway, but first we're going to catch up on all the news that has happened over the holidays and right now. And then after our vibrant discussion with Sucharita and Simeon, we're going to talk about what we are finding remarkable this week and what we're keeping our eye on in this dynamic industry. Now, Steve, for 2026, you've pretty much transitioned out of you had a great email database, you would be sending out emails. You've kind of transitioned that over to Substack. Tell us all about it.
Yeah, just really quickly, because we have a lot to get to. I launched a Substack newsletter called Pardon the Disruption about a month or so ago. So I'm 4 or 5 episodes in. It's weekly. And it's a different platform, a little different content strategy. I'm going to be doing sort of longer content pieces that I've done. It's actually getting back a little bit to I started my writing career blogging 10, 12 years ago. So yeah, check that out. We
are live on the show floor. We are live in the Narvar Podcasting Studio at the NRF Big Show. Let's get to the news of the week. Let's start with holiday sales. We got some numbers out first thing this morning. What make of you?
Yeah, in some respects, I'm not sure it's worth spending that much time on because the holiday kind of came in as expected. If things we talked about in terms of predictions, depending upon the source, depending upon the exact time frame they use, sales were up around 4%. About 3/4 of the sales were done in physical stores. It's pretty much in line with the predictions and more or less in line with last year. Online sales up just under 7%. That's also very similar to the predictions, very similar to last year. So I don't know that there's a big takeaway from that. I think when we really will start to understand better is when we start to look at the performance of individual retailers, the profitability. But I did, in the Adobe Analytics data, what I thought was interesting about online sales, they said, and I haven't seen this anywhere else, that returns were down. And of course, we're in the Narvar studio, so we're interested in returns. But I don't mention that just because I assume the only explanation is because they're employing their technology.
The quality of
it. But as we've talked about, returns have been going up. And particularly in e-commerce, and so it's interesting to try to understand what went on there because it's not obvious to me what would have made a change across industry. The other thing I thought was an interesting stat, which I hadn't seen in a while, was the use of curbside. So that gets counted as e-commerce, but according to Adobe, 17% of all holiday orders were click and collect.
Really?
And so I think that, once again, speaks to the role of stores, even if something doesn't get rung up in the store, it may very well be fulfilled by a store. So it turns out physical retail isn't dead.
I don't have a good sense. Was it 15% last year? Like, I haven't seen, you're right, I haven't seen this number published in a long time.
The number that I have seen most frequently, but it's for the entire year, is 9 to 11%. So I kind of anchor on around 10. So now, I guess you could say because things are so crazy and you're maybe worried about getting things delivered on time, that might push a higher level, but I don't know what the typical holiday number is. But that's a very, very, it's a huge, huge amount of volume. So the other thing I'll just mention really quickly is this morning as we're recording this, so the day before this episode comes out, Monday, CNBC and NRF released their monthly sales. So this is obviously a good chunk of the holiday sales. And they were up strongly again, not too surprisingly, about up 4.5%. Usually when we talk about this, we go down to the sector level, and continues to be a similar trend of big ticket products, home products tending to be flat-ish or down. I know you called out the home improvement
down 5%,
numbers. Yeah, down quite a lot, which I don't know whether, who knows. And then a couple categories that continue to be strong are clothing and accessories and the beauty category and sporting goods. And so, but that has been a very consistent pattern, I think pretty much for the entire year. So again, I mean, we call this news. There's not really a lot of news because it's kind of what we expected and kind of what has been happening.
You know, one of the things I saw, I was reading some feedback from Home Depot, and they said, you know, the good news is there wasn't a lot of big hurricanes or huge weather, traumatic weather versus last year. That's the good news. The bad news is, you know, they sell a lot of stuff in that business. So
it's like when there's a tornado, like mixed feelings working at Home Depot.
Well, yeah, it's like, you know, when there's a pandemic, it's good to be a pharmacy, right? Kind of thing. So it's hard to comp off those numbers.
Yeah.
So, all right, hot on the heels of the demise and obliteration of a 4-century-old retailer in Canada, Hudson's Bay, the story continues here in America with Saks Global bankruptcy. Looks pretty imminent. Rumors here on the floor could be counting the hours, counting the days.
Yeah, as of this morning, the most, specific rumor I had is that they would be filing on Tuesday. So that will be when many people will be listening to this episode. So my guess is very, very likely that by the time people are listening to this, or most people are listening to it, they will have filed. We've talked about this a bunch of times. There's going to be a lot of ink spilled on this, I'm sure, over the weeks to come. But I guess I'll just say very, very quickly, and you know, it kind of depends on whether you've listened to the podcast before. When this deal happened over a year ago, I could not figure out how the financing made any sense. You could argue that the strategy, when you've got a contracting industry, consolidation, rationalization, would make sense.
Sure.
But a lot of the rationalization that had to happen, in my mind, was closing excess locations. And maybe a different day we'll go a little bit deeper on this, but it's very difficult to get out of those, to negotiate your way out of those leases. And because they're long-term leases, you cannot change the composition of your portfolio very quickly. So both the incredible debt load that was taken on and the need to get out of those stores, in my mind, it just seemed like we were going to end up in Chapter 11 somehow or other. Subsequently, it also turned out that the financing didn't allow them to reestablish their vendor relationships, so they've had a lot of product flow issues, they've had a lot of turnover, so the operations of this were definitely much worse than you would have hoped for during the past year. Mark Metrick, the CEO...
Speaking of turnover.
Yeah, left. I can't remember if he had left before. I think we were done with our final episode. He resigned a couple days after that, so he's gone. So anyway, again, it's a long story how we got here. I think this was inevitable. What I suspect is going to happen, and you know, I may be wrong very, very quickly because people will know what's going to happen.
Or has happened.
Yes. But I think they'll file Chapter 11. I think they will secure $1 billion plus in debtor in possession financing, which will allow the product flow to continue, which is hugely important if you don't want to basically cause the business to completely go under as they figure out what the reorganization plan will look like. I suspect the reorganization plan will include bringing in new management. It's already been rumored that Richard Baker, it's been insisted by the people that are going to finance this thing that he be out. I think they will bring in an experienced luxury department store executive, presumably. Some rumors that Geoffroy Van Rondeboek, or GVR as he's affectionately known,
might come back.
Who was leading Neiman Marcus before the acquisition, might come back. I think he would be, he certainly knows the business well. He's credibility with
vendors,
the vendors, right? So that's critical. But there are, I'm sure, some other people that I know or don't know that could be there to be able to both operate it as well as work through the bankruptcy proceedings. So, but they'll have plenty of advisors. The one people that make money in a bankruptcy are the advisors.
Right.
The lenders, the equity holders, the management may not so much. But I think ultimately they will be able to reorganize under Chapter 11 pretty quickly. I suspect they will close 8 to 12 Saks Fifth Avenue and Neiman Marcus stores, largely in where there are duplicate locations. Probably a couple of smaller market stores that are underperforming. One of the unfortunate things, I don't want to get in the weeds too much here, but there's really a bias in these reorganizations to close more stores or err on the side of closing more stores because of the nature of the leases. Because you aren't, as I said earlier, it's very difficult to negotiate out of these leases. So people that are interested in that, want to talk to me about it. I'm happy to explain that more. But anyway, trust me, it's a real problem. So I think, they got one shot, hopefully, at getting this right and really shrinking the store portfolio. So I think that will cause them to close quite a few stores. I mean, that'll leave them with 45 or something. I don't know the exact number. I also think they're going to close a very large number of off-Fifth stores. I think they have about 70. I wouldn't be surprised for them to close 30, 40, 50 even, because I don't think that's a particularly profitable part of the business. That's not super important to the long-term success. So anyway, I don't know how quickly this will all transpire, but I would imagine fairly fairly quickly because I think it's a pretty straightforward path as long as they can get the funds, the financing to get the product flow. Because the spring season is here, and so if you can't, as we often say, if you don't have it, it's hard to sell.
Hard to sell it. I got great feedback over the holidays with our interview with Mark Zandi from Moody's, a real economist. Now let's play the economist on the podcast. U.S. job growth numbers came out. What did you think of them?
Yeah, just last story here in the news. Well, if you look at the whole year, the U.S. market hardly added any jobs. I think December was the worst month since for like a dozen years. And the overall sales growth, I mean, there's some charts out there if you're super interested in it, I'm sure you can find it, which shows U.S. job growth over time. And the one thing you notice is come about January of this year, job growth really flattened out. And so the job growth has been at something like the quarter of the pace for the prior year. Now, there's lots of reasons we can hypothesize about why that is, but I think clearly there's significant deceleration. There are all these fears that AI is going
said
to...
that, right? What do you call it? Fingerprints. There's some fingerprints on
So,
AI.
How much of this is economic uncertainty? How much of this is AI? How much of this is, store closings and things like that? But I will point that, really where jobs were created were largely in healthcare. And where the jobs were lost were in retail and in manufacturing. So at this point, the tariff program is not bringing manufacturing jobs back. We can argue about whether or not time will tell on that one. But in any event, that is the realities. Now, one of the interesting things, and probably a topic for another day as well to get into as we get more economic data, is the unemployment rate hasn't moved very much. And the reason for that is because the supply has been constrained. Now, I haven't seen a really good deep dive on how much of this is related to virtually no immigration. I think 1.5 million fewer people came into the U.S. legally, as well as whatever we think the number is illegally. We also had people leave at a higher rate than is typically the case. But there are also people that have stopped looking for jobs because they don't think their prospects are very good or for any number of other reasons. So it's really kind of an interesting thing where you have very little job growth, but unemployment has stayed low. So this is, be very much, I think, something to watch going into next year.
All right, well, that's a wrap on the news. Let's leave it there, and let's get to our very first analyst segment of 2026 with Sucharita and Simeon. Well, welcome back, Sucharita and Simeon. Simeon, you've abandoned the Canadians now and work for someone else. Who do you work for, and did your coverage change or adjust anyway? Happy New Year, by the way, to both of you. Jumping right in. But Simeon, what do you do for a living now?
Happy New Year. You never really abandon family, please. It's a harsh word. You just get re-embraced. I am currently now very excitedly to be back working for Guggenheim Partners based out of New York City.
Nice. And did your coverage profile or what you look at change in any way, shape, or form that you want to share with us? Or is it basically doing the same great work you were doing, but just with some different perspectives for who you work for?
I thought you were going to ask, am I just a little bit meaner now that I'm no longer in the Canadian fold? But no, I like to think I am equally as mean. So my coverage is still generally the same. I added a few, I lost a few, but high level. If you're discretionary, if you have brand dependency, if you sell something irrational to consumers, I love it.
Fantastic. Well, thank you both for joining us this first episode for 2026. Now, it's not exactly a backward-looking discussion, but as we look back on the year that was, a couple of questions for both of you. In aggregate, it was a strong year for retail, but there's quite a wide range in outcomes. How would you best characterize the year that was 2025 in retail? What would you say were the key performance drivers, and anybody impress you? Sucharita, kick us off.
I think it was a confusing year. I think that there was just a lot of cognitive dissonance, the biggest being that retail spend was at its highest level ever, but consumer confidence was at record lows. And I think that puzzled a lot of people. That puzzled Wall Street. It puzzled a lot of executives in retail who struggled with making sense of the data, struggled with making sense of what were the marketing messages that resonate with consumers now, and what are even the products that people are purchasing now. Are they purchasing durables? Are they not purchasing durables? Are they, are they trading down commodities? Are they purchasing apparel again or not? Or are they only purchasing on Shein? So still a lot of confusion.
Simeon, are we living the K economy here? Is this what you're thinking or how you're seeing it?
I don't think we are. Listen, I think that it's an easy story to tell, and I think we will always gravitate to easy stories. But we're looking, my favorite line over the last few years is execution matters. It's good operators win, bad ones don't. And when everyone does well in a COVID environment or doesn't do well in a COVID environment, we get used to clusters. But that's not how stories work. And so there are luxury businesses that are not doing well. There are luxury businesses that are. There are big box that are. There are big box that are not. And so what I think we're really seeing is market share. And I think to Sucharita's point, you have to look past these headlines to see what's really happening. And I think what's really happening is really encouraging. I think there are winners. I think that it's very easy to look good when the wins are at your sales. It's important to look good when they're not.
So would you maybe point out 2 or 3 retailers that you think really stood out in terms of their execution, but also their fundamental strategy?
Yeah, so I was going to jump in, but I figured I would leave you that like open mic moment to be able to ask the question to keep it more conversational. So that was that.
We try to really specialize in awkward pauses if we possibly can.
I like the suspense. So this way Michael can throw in some sound effects afterwards, like dun, dun, dun.
Wah, wah, wah.
No, listen, I think what's really important is you can look across the landscape and you can say, this is not a stock conversation for right now. I'm just going to talk about companies, but you can see revenue growth. You can see that for all the fear of certain businesses, like again, LVMH had raised questions just as Prada was doing really well, as Hermes was doing really well. You can look at a distinction between Walmart and Target. You can look at a distinction between Coach and Michael Kors. You've got businesses selling the same thing to the same people, seeing drastically different results. And so it's hard to call out the K economy as pressuring companies when you watch TJX and Ross Stores continue to gobble up market share at the same time that you're seeing the goods and the bads across some of the luxury players. And so that's kind of how I'm thinking about it. Whereas there's no question, right, to not be insensitive, there's no question times are tough for very many people. But healthy or not, good or not, the U.S. consumer is wildly overly resilient. And I mean, Steve, you joke around about it a lot. Like a bad holiday is an up 2.7. A good holiday is an up 3.4. Like, what does that mean, right? Like people are spending. And so I think that is important, where whether or not people are feeling pressure when it comes to the discretionary side, when it comes to holiday giftable side, people do force that spend and it shows up.
But isn't the issue, I'll push back a little bit. When we say the consumer is resilient, I think what we're really saying is like 10% of the consumers are incredibly resilient. Because if you look at I've seen some data, maybe you've seen this as well. If you look at consumer spending across the last 5 years, the top quintile of incomes, it's up like 40%. If you look at the bottom quintile, it hasn't come close to keeping pace. And so I think when we say the consumer is resilient, there is no one consumer, right? Like LVMH doesn't target the consumer. They target 3 to 5% of consumers. TJX, targets 40% or whatever. So I guess that's what I'm just trying to get from a strategy standpoint. If you're a particular retailer going after a particular set of consumers, averages don't matter really, right? So is there anything you'd point to of people that are like really are executing against that as opposed to just, riding the tide and maybe doing a little bit better?
And that's what, right. I'm glad you asked it that way, because I'm not an economist. I'm not going to pretend to be in that idea of projecting from the top down what the average is going to be. That's a little bit my comment about the 2.7 versus 3. But I don't think that matters. My point is when I look at companies, because again, you and I are not making a collective view on how the consumer is. We're using that view to try and determine how to be the best and optimal retailer. And so my point there of in a supposedly and realistically very challenging environment, Marmaxx comped a 6 last quarter.
Yeah.
Ross comped a 7. Gap comped a 7. Like companies across the board that should have, Old Navy, right, up there also, mid to high single digits. Companies that should have tremendous amount of pressure. By the way, our favorite, Nike, huge North America performance last quarter. And my point being, employ that strategy of finding that consumer that's going to spend, even if the average suggests otherwise, and you will find that you're taking share from the other side of that average. You'll find that you're winning. And I think you could do that in any environment. And that's why I love focusing more on the micro than the macro, because the macro will always tell that story of that 6 foot deep river that you're never supposed to cross on average.
Right. Sucharita, what's your take on these topics?
Well, I think that there are questions around TikTok shop and, kind of micro sellers. How much of, I mean, and these are online plays, although online is of course continues to grow. The question is are those merchants, it's essentially a marketplace, right, of really, really small sellers and Chinese players. How much is it taking share from some of the traditional mall merchants or other retailers that are more known brands, and Amazon continues to just be. I mean, I think if you were to look at the largest numbers and who's continuing to grow, I think that at the low end it's Walmart, Amazon, and to a lesser degree Costco, because Costco does. It does skew affluent consumer, but I would say that it's probably more middle class than anything. Yeah. I mean, those are the players that are kind of eating everybody else's lunch.
Yeah, for sure. So another question I have is, I just saw some data about the growth in e-commerce for the holiday season, and of course, surprising nobody, it was a record year, and e-commerce growing faster than physical retail, but the growth rates have really slowed down. So I think we might, I don't know, different folks have different numbers. Perhaps Sucharita, for Forrester, you got a more official forecast, but it seems like we're kind of in the 7, 8, 9% growth range for e-commerce overall of late. Amazon's growing 9, 10%. Walmart is growing in the teens. So if you actually back out the two really big players, overall e-commerce growth is, I'm guessing, more like, inflation. So I guess I'd love your perspective on what is going on with e-commerce that we're seeing such a deceleration, and do you believe that some of the things that are going on with agentic commerce, kind of what Amazon has been pointing to, is suddenly going to reaccelerate e-commerce growth? So there's a lot in that question, but anyway, Sucharita, you want to start off on that?
Well, it's sort of the law of large numbers. I mean, e-com is now $1 trillion in the United States, so it's single-digit growth. You're right, but it's still high single-digit growth, and it's still more than double what store growth is. So it's still taking share from physical stores, but is it approaching maturity? It looks like it is. I mean, at the end of the day, in the United States, physical shopping is ubiquitous. It's still incredibly convenient, and there are a selection available in physical stores that isn't always available online. So it doesn't surprise me that you still have a lot of kind of a lot of shopping still happening in physical stores, especially in grocery, which continues to be a holdout, which is kind of where some of these saturation numbers are coming from. During the pandemic, that was supposed to be the catalyst for e-com growth for the foreseeable future. It ended up not being that way because, people still buy their groceries in the United States in physical stores. Is it worrisome? Is it troublesome? It just means that we're approaching maturity for a lot of .com merchants, and they need to start focusing on tweaking and improving and fine-tuning the business and the offerings. They can't just ride the e-commerce rocket.
And by the way, Steve, I'll throw out an idea that is like a total brain fart. I'm sure Sucharita has numbers that can either support or totally contest this, but just the sheer idea of what e-commerce used to be in terms of, hey, give me everything as the consumer. Yeah, I keep seeing headlines about returns being high, but also keep seeing the reality that they're now being charged for. And e-com is just not as, call it, simple and free as it used to be. And so I think the real answer is obviously what Sucharita said in terms of, as the business gets bigger, we should see these rates normalize down a bit, even though they're healthy, even though they're adding incredible dollars. But I think on top of it, some of the reasons for e-commerce might be getting slightly dulled. And again, I don't want that to be hyperbolic. I don't want that to be some, oh my God, e-commerce is over. But I think that, I don't know, anecdotally, which is something we were never supposed to do, I think you do reconsider certain purchases you may have otherwise done, knowing that it's going to come with that $7 shipping fee.
Right. And also I think retailers are reconsidering how much they want to, throw into that hole. What's that old saying, when you're in a hole, step one, stop digging kind of thing. So maybe wrangle around those returns. Changing tack a little bit, in our last edition of the Analysts, we were opining or wringing our hands or talking about tariff impacts coming that might impact Q4. It didn't really seem to, I don't know.
Are you just trying to make me feel bad that I wasn't on that one?
Yes, but I know you listened to it because,
you would have set us straight and had some totally different take that none of us could have anticipated.
You would have opined.
Would have given you something to laugh at.
You would have given us something. And now the something is, what happened in Q4, there's some thoughts that, really retailers were selling inventories they had brought in pre-tariff, and there were just some of them are eating the tariffs and whatever. Simeon, what do you think happened? And, spend a minute on that. But what do you think is going to happen in 2026? Are there tariff impacts that we need to consider, or are we past talking about tariffs and we're on to something else?
Tariffs are fascinating. And somehow, still, January 2026, part of the issue is we still don't know what they're going to be. And we are waiting to find out if everything that was put in place is reversed, if what was put in place is held but is going to not be held go forward. Like, there's just a lot of different factors that when we are recording this, the beauty of podcasts, we can record something before it actually happens. So this might be moot. But I think the interesting thing is, as we look backwards from what we know that happened this past quarter, the one thing we know is that there are widely different conclusions. The companies called out widely different results of tariff impact. And I think the best way to explain why is the timing. I think there's different quarters end in different months, and different companies report in different months. And the earlier you reported, generally speaking, the less tariff impact you called out. The later you reported, the more tariff impact you called out. That's really interesting because timing catches back up. And so I think right now, what we are going to determine, if nothing has changed so far, nothing changes. The big question is, does it make sense that really any company totally sidestepped tariffs? Probably not. Even with Tapestry, with the best pricing opportunities that they are capitalizing on, still called out, I think it was 70 basis points of pressure. It was still a meaningful number. And so pricing is great. It's just not enough. But that means that certain companies will have to then pay the pipe or pay the toll as it comes. On the other hand, if things reverse, you're looking at companies like Lulu and Under Armour and Nike, companies that called out material pressure points that may get some relief. And so I think it's a little bit comical that, and I just say comical because it's the easiest word, it's kind of sad, but that in January 2026, we are still talking about what the actual cost is, and that makes it very difficult to plan a business. But I think once we can finally find that out, we will see which companies need to absorb more pressure versus which may have already accounted for enough or too much.
Sucharita, you're a great strategist. If you were in the chair of the businesses trying to plan for 26, you would probably do multiple scenarios. But how would you plan this out, and what would you? This uncertainty. I mean, doesn't feel like this Supreme Court decision might affect things like de minimis, the end of de minimis. How are you thinking about this, and what's your advice about how we should think about it in 2026?
Well, from the conversations that I had with retailers through 2025, I mean, they've been thinking about this like pretty much since 2016, and they've been thinking of diversification and kind of everything, like lobbying their local politicians to try to get exemptions if kind of their category is affected. It could be one where the market has a roaring rally because kind of it's a very pro business outcome, or it could be one that that probably is maybe more of business as usual and kind of concerns around hunkering down, thinking carefully about your strategic partners and where you want to diversify manufacturing in the future. And there are a number of players that even with tariffs, Chinese manufacturing, as an example, is so inexpensive that even with the tariffs, there's nowhere else in the world where they can even offshore to. So it is a little bit of I mean, what do you do? I think that if you are a retailer, the K-shaped world also affects the retailers, and there are ones that are doing okay, and they're going to continue to invest in technology and robotics and agentic AI and all sorts of things to try to increase the lead that they have versus their competitors. And there are ones that are struggling that I think are just going to be rich targets for private equity buyouts.
Interesting.
Yeah. Hey, Sucharita, maybe you kind of we'll do a little bit of a shift here, but maybe spend a little bit of time on technology. We managed to be a good, 20 minutes or so into this conversation without AI coming up, which is perhaps a record.
Shocking.
I know. Harkening back, and then we'll look forward. But I believe you said on your last appearance that you thought perhaps AI was more on the hype side of things, and a bunch of months have passed, and we've seen lots of announcements. I'm curious, number one, whether you still think that AI, and I guess maybe agentic AI and AEO are being hyped too much, but also, are there any other technologies? You mentioned robotics, that's one that comes to mind, that perhaps you see maybe not the same amount of impact, but very significant impact that maybe retailers aren't paying as much attention to, unless you happen to work at Amazon, which definitely seems to be paying attention to robotics.
Not all AI, Steve. I think my point was about generative AI.
Yeah.
But I think that, AI has been adopted to great success in retail for a long time, particularly when you're looking at, things like deep learning and machine learning and fraud detection and all sorts of embedded technologies in retailer operations. There's I guess the phrase of 2025 was agentic, and it too means so many different things. There's all these players like ChatGPT and others who are appropriating agentic commerce to basically mean transactions on their owned properties. And but agentic commerce can actually mean a whole bunch of other things. It can mean transactions on Amazon through Rufus, or kind of some other retailer enabling a chatbot that lets you buy. Will all of agentic commerce fail? Of course not. There are going to be agents in commerce, and by the way, agentic commerce can also be back office applications that enable commerce and make things, kind of much smoother and faster. So I think that the part of AI that I'm skeptical about is whether or not people are going to be buying products on ChatGPT, because I think that's the prevailing thesis that a lot of people are running around speculating. And literally conversations will start with phrases like, well, in the future, when everyone buys on ChatGPT, and it's like, that is not an inevitable future. And you need to, kind of take that out of your mind. But that doesn't mean the idea of agents, which are stitching together disparate data sources to make things better for business users and, kind of maybe by extension for some consumers as well. That's absolutely likely to happen. How much of that efficiency is going to be owned by ChatGPT? I'm a little bit, that's the part I'm skeptical about.
Gotcha. And then with regard to any other technologies that maybe you think should be on retailers' radar screens, or maybe not getting as much attention as they might deserve?
So one of the things, so I'm at CES, and one of the things that I thought was the most provocative insight was we take all of the geopolitics that's in the world now and concerns around, and there are different parts that are owned by different players, right? You have chips and you have the actual algorithms and, kind of, and bringing it all together does require a lot of collaboration in the face of geopolitical strife. And how do you do that, kind of in a way that doesn't increase your costs? Because, and I don't think you can. Like, it becomes impossible to not do that. And what I mean by that is that you have to increase your expenses in cybersecurity and transparency and controls and protocols, and kind of making sure that your IP doesn't end up in the hands of people that you don't want it to. So in the face of that, how what that basically means is that we had offshored so much to save costs, but because of our paranoia and because we're picking fights with so many people, we now have to, and maybe not just, it's also like legitimate concerns about losing competitive advantage. You have to, increase those costs that were much lower in the past. So, so in that kind of an environment, that's where if you can invest in robots to have all of your manufacturing and as much as you can nearshored, then that's kind of ultimately your ticket is to invest in hardware automation as close to your country as possible. So that I thought that was an interesting insight. I don't know that I was a little bit of rambling and it may not have made any sense, but
I just want to throw in one comment in terms of data and ChatGPT. I think it is obviously very different, but it's important to remember that this rhymes a lot with D2C. And, it's my favorite oldie, but I think still a goodie. The biggest brands in the world that sell through wholesale don't have the data that we all believe is absolutely so critical. Yep. So I just think we went through a decade plus believing more data meant guaranteed success. And we finally came out of that realizing it's not how it works. And I just want to make sure we don't end up down the same rabbit hole of the more data means absolute guarantee. It's just not. Data is great, but it's not the be all end all. And it more often than not, having strong partnerships can be better than having perfect data.
Simeon, quite a few retailers in the midst of turnarounds. We're switching gears here a little bit. You've mentioned them all so far in the podcast, but let's go a little deeper. Let's handicap a few of them. Let's talk about Nike, Gap, and Lululemon.
By the way, how often do you bunch those three together? Isn't that fun? Sure.
It'll just be NGO from now on. We're just going to acronym it.
We acronym everything. Okay, so I think all similar in that they are going through a degree of turnaround, all different in terms of they're at drastically different stages and are very different businesses. And any retailer who does it right ends up in turnaround mode at some point. Anyway, so Nike first. Listen, my view. I think it's important to acknowledge that when Nike is losing, Nike is still winning. These businesses start at zero every single year. And when Nike supposedly couldn't sell a single thing because it's lost all of its hype, it still generated $47 billion of revenue. That's a lot. That's more than most of its competitors combined. And so I think we have to, again, stress the difference between maybe volume versus voice, or maybe market share versus mind share. And listen, this is obviously coming from your Wall Street friend, so I'm only supposed to look at growth, and I'm not supposed to look at what comes before. But I think it's always important. Like, I get that we look at comp. It's very important. But if something declines by 3%, if my math is right, it still means it got 97. And so I think that this is a very important thing to keep in mind. And so now with that said, so laying the table, I think Nike, or setting the table, mixing my expressions here. I think that Nike feels to me, and we've talked about this last year, I think Nike feels to me very reminiscent of what they went through against Adidas a decade ago. When Nike has competition, when a new product comes out, it takes some time for Nike to catch back up. What they do in the interim is they reintroduce and maybe flood the market with their classics. A decade ago, it was Jordans. This past go around, it was Jordan's Air Force Ones and Dunks. At some point, that hits a wall. You've effectively diluted your brand, unfortunately. But then what they are doing, I believe, is coming out with a rhyming product. So a decade ago, the Ultra Boost met its rhyme in the Epic React. Weird, even had the word react in it, but it was there. They looked very similar, and all of a sudden Nike was back. If you look at the Vomeros, it feels like Nike has created their rhyming product with big max foam sole cushion shoes that they rhyme with the products that took their shelf space from Hoka. And so I think it takes time, but what I'm looking at is the fact that, yes, there are tariffs, and yes, there's China pressure, but North America has put up material revenue growth the past 2 quarters, and that's generally pretty good signs. And so for Nike, do not think we're out of the worst of it. I think that there's obviously pressure. I think they still have an uphill battle, but I think we're seeing the signs, we're seeing the breadcrumbs of a brand that has now regained the path it needs to go on to come back.
All right, let's talk about Gap and Lululemon. Lululemon's very interesting to me, obviously, for a whole bunch of reasons, not the least of which is governance. That's really...
The leggings are the reason.
The Vancouver leggings.
You didn't drop the Canadian card there.
Well, I kind of alluded to it. You see, I think
that's where he was going. I just kind of pivoted him. I think that Lulu is a fantastic brand. I think Lulu is a strong brand, but I think, with all puns intended, I think Lulu is an overstretched brand. And, my team has done a lot of work on where brands ubiquitize. I've stopped saying the word peak. It's not peak. It's where they ubiquitize. They peak higher, then they come back down. But $3 to $4 billion in the U.S. I don't want to say North America. I want to say the U.S. because Lulu obviously is entitled and permission to have a much larger Canadian business than a lot of U.S.-centric brands. But $3 to $4 billion generally is the level where these brands find a healthy saturation. They stretch up and they come back down. And so I think Lulu's great, but I think to be able to drive $6.5 billion of revenues in the U.S., somewhat by definition means you've stretched beyond your core audience, means you've had to give up what made you special to be able to reach that volume. And so everyone that talks about, listen, Alo and Viore are doing great jobs. They're doing great jobs at much smaller revenue levels. Mm-hmm. And so Lulu is still similar to Nike, starts from zero, gets to that level every year. They're still selling a lot of product. I just think they have stretched beyond I have to stop saying the word stretch. I'm not even doing it. I think they've gone beyond what they are effectively entitled to do from a special brand and have effectively pivoted into the stage of their life cycle where they're just a big brand. And I think what they want to do is regain being special, regain being unique. And I think to do that, my fear is you have to be smaller to be better at this size.
Interesting. Sucharita, let's talk about Target. I mean, they've had a kind of leadership change, kind of sort of. They're clearly trailing, but to Simeon's point, they're still a massive business. How are you feeling about the Target business today?
Target has just been a mess, haven't they? And it doesn't seem like. I would have thought that when they had their leadership change, they may have brought somebody from the outside.
Well, I turned them down, Sucharita, so that's what they wanted. But they had to
they're
settle
lost, Steve.
He's waiting for the Lululemon job.
Retail's gain. So Target is not an unfixable issue. It's not like Sears, right? I mean, they actually still have a lot of consumer love, and they have great locations. It's been a series of operational missteps. And a lot of that has been everything from merchandising that probably didn't hit the mark to definitely store operations, which continues to be a hot mess. And those are some of the things that are usually pretty fixable. So I don't understand how they're not making, at least from a store operations standpoint, the stores are just not clean. They just don't, process people through checkout quickly. It's, things are missing, not in the place where they're supposed to be. So I mean, those are 101s of retail. And I don't understand why Target seemingly hasn't got it together. And I don't know whether they're just being deceived by a handful of store managers who trot, kind of executives through the handful of well-run stores. I mean, I just don't understand. It's baffling. Like the data is no doubt clearly in the numbers that, certain stores are not performing. And they're not looking at who they're losing share to Walmart and Costco. And or otherwise, I think that this would be fixed by now.
One of the things I've been thinking about is kind of redefining total addressable market into like realistic total addressable market. And part of what I wonder about Target, I mean, I agree with you 100%. There's lots of executional things they could fix or should be able to address, and that will improve their results. But to the extent Target was somewhat a business model on its own, this step up from a Walmart or a discount mass merchant, I just wonder if the market has changed so much that there isn't as much upside room for them, because Walmart is so dominant in grocery. They're never going to catch up with grocery and get that frequency. There's just so many places to go to get value-priced apparel and home products. And, the Walmart model, the Costco model is so much more driven by frequency, by grocery, and they're so far behind there that I just wonder whether, sure, they can improve this thing, but as a practical matter, their total addressable market is really quite a bit smaller than it was 10 years ago because of the way retail has shifted. Does that make any sense as a concept?
No, Steve. I mean, they gained so much share during the pandemic. It was the first time they were ever 100 retailer. I mean, and their total addressable market is like almost every consumer good. And to me, it just seems like it's an executional issue. I think Simeon raised a really good point about Lulu's addressable market. And I think that's solid. Like when you're going after high-end niche products, yes, you should not try to aim to be a 10 or $15 billion sector with just that brand.
All right, well, great discussion, and let's point our minds even further ahead as we cast our mind forward. What do you think? Two stories that we're going to emerge that perhaps might surprise us, things that not everybody's talking about, but the two of you are focused on. Simeon, what are you thinking about? Anything come to mind with you or your team?
I think number one I think price will be a very important conversation. I'm surprised it didn't come up so far, but I think a lot of companies, surprisingly or not, got to benefit from price in a way that we haven't gotten, honestly, since COVID, vis-a-vis the tariffs. And it will be interesting to see if price becomes a weapon again on the reverse side into next year, as companies decide how to start driving units. So I think that's number one. I think number two, again, you asked about the K-shaped economy. I think the question will be, do we start seeing more companies? Do we have interesting market share stories that emerge? Does Nike rage their battle back? And when you have big businesses that regain market share, what does that mean for some of the companies that were able to take advantage of the air pockets that no longer exist?
All right. Sucharita, what about yourself?
Well, it sounds like we're going to probably get maybe better interest rates in the coming year. Hopefully, particularly if inflation goes down. And what that means is that should mean the cycle in the home improvement and the home sector should go back up. It's, I think, been a little challenged recently.
We're also probably at that point where all that stuff we all bought during COVID is really starting to wear out, right? I think there's still that little bit of a restock tailwind after all that stuff.
You guys are buying new Pelotons?
Well, there's lots and lots and lots to think about. Thank you both for fitting us in. It's a busy week for everybody, with NRF being so close to in January now. It's right on top of us as soon as you come out of the holidays. So thank you both for squeezing us in. And Sucharita, you're at CES. So lots going on there, I'm sure, as well. And Simeon, new gig, new year. Thank you both very much for joining us on another episode of The Analysts.
Thank you, as always.
Great to be back. Thanks for letting me come back after my miss.
All right, we're back to wrap up the episode with what we thought was the remarkable story of the week and what we're seeing around the corner coming up. So kick us off.
Well, I thought the most interesting news was, and this may or may not happen, but Amazon is seeking zoning approval for a superstore.
Not a 4-star store.
Not a 4-star store, not an Amazon Fresh store.
Not a Go store.
But a superstore. And we're talking, go big or go home. 229,000 square feet. That is roughly 50,000 square feet bigger than the average Walmart superstore. So I'm sure many people are familiar that Walmart's superstores are quite vast. So this is even vaster. And apparently it is going to be rather similar, at least in the things they file, in that they will be carrying grocery products, apparel, accessories, but it'll be a general merchandise store plus some space devoted to fulfillment. So I suspect that this would be perhaps fresh grocery fulfillment as well as just other products that might be delivered, but really like a micro-fulfillment, highly automated sort of site. So some of that space, I'm sure, some of the size can be accounted for the degree of fulfillment that will be in there, which would not be typical of a Target or a Walmart superstore. But very interesting. So Chicago suburb called Orland Park on southwest side of Chicago. We will see if it gets through zoning. So this is not a fait accompli, and certainly it will take quite a long time to build this. But again, here's Amazon with endless resources trying another physical to retail format. Whether the world needs this or not.
Not exactly novel.
Yeah, is TBD, but as we've talked about many times, part of Amazon's ability to sustain their growth is to go into those categories which are physical store dominant, and here's another attempt at doing this.
And listen, a store that big, you could drive your car right through it and just throw the product in the aisle in the trunk if the store is that big. Speaking of...
what's yours?
Speaking of stores, and speaking of, you gave us a little en français there. I had the privilege of doing a store tour with Canadian retailers, and it's not exactly a story, but it's my observations of what I saw. And we started at Printemps, so speaking of the French, shout out to Michael, who gave an amazing tour about the history and the assortment and the rooms. I learned a bunch of stuff that I hadn't seen. And we were off to the new Gymshark location, which is a testament to a relentless focus on merchandising and the store. And then we went to Target, and we wrapped up at Tecovas. Great hospitality there. So not exactly a story, but I'm always confident that I can come here each and every year and put a tour together. And it's not a lot of cities you could say that.
Yeah,
that I can take you and have a choice of a bunch of places to take you that are brand new and you've never seen before.
Yeah.
So it remains the kind of the brand of New York that there's really nowhere else in America or North America you can do that.
So we're going to have to get the New York Tourist Board as our sponsor.
All right, let's talk about what's on our radar. What are you thinking about, and what are you thinking about what's around the corner?
Well, again, this may be another story where perhaps people will have heard the outcome by the time they listen to this, because we are awaiting the Supreme Court ruling on whether Trump's tariffs will be vacated. There was a little buzz going on last Friday that there might be a ruling, and that didn't happen. And now the buzz is that perhaps it will happen this week. The truth of the matter is we really don't know, but it also, just like the Saks bankruptcy, seems perhaps imminent. And depending upon how that comes out, that's got major ramifications, obviously, for U.S. retail, but vendors around the globe that may or may not be subject to tariffs. Will things be refunded, which will have a big bearing on certain retailers' profitability? And so, a lot could happen. So we shall see. I am not about to handicap what the ruling will be, what the implications. Presumably, I don't know. There's some measure of appeal, I guess, or some measure of negotiation in terms of the implementation. So,
can you negotiate with the Supreme Court? I didn't think that was a thing.
I don't think you can negotiate with the Supreme Court, but I imagine there's some interpretation as to how, in the case where there would be refund. I mean, if they can continue, I guess we're where we are. If they cannot continue, is the ruling, going forward? Is it you have to refund all this, and then what is the refund practice? What if the refunds don't occur?
It gets back to that Costco lawsuit, right? Maybe that's what they're trying to get ahead of.
Well, and I don't know if I'm breaking any news here, but the Trump administration does not always do what they have been told by courts to do. So anyway, we shall see. Hopefully this will be much more clear sooner rather than later.
Well, on my side, and it's kind of a Canadian story specifically, but also has applicability around the world, is it's 2026, and we've been working on our side of the border on legislation around retail crime, organized retail crime, and violence in stores. And we've made less progress in Canada around bail reform, and we find the same characters over and over and over, rearresting. And I think the U.S. has done a better job. Part of that is, in Canada, we don't have elected positions for, you would call them district attorneys. We have crowns and judges and sheriffs. We don't elect those, so it's hard to get on their radar screen. But we've made it a big emphasis at the political side, and I think we've made some headway. So we're looking forward to that in 2026 in a matter of weeks to see some legislative change that might help retailers, because they're really struggling with repeat offenders, and we think there's a legislative solution to that. All right, well, that's a wrap on this episode, our first 2026. And, looking forward to the rest of the show. Once again, we're here in the Narvar podcasting studio, and you're going to hear lots of great interviews. We've already done a couple really fantastic stuff, so stay tuned.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to StephenPDennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.